From our studios in Scottsdale, Arizona, this is Retirement News Online. So for decades, bonds have been the traditional safe part of a retirement portfolio, but over the last several years, investors have learned that bonds can lose value, fluctuate with interest rates, and struggle during periods of inflation. And today we're asking a very accomplished financial advisor whether bonds still belong in a retirement income plan and what other strategies retirees should be considering. And this guy is Drew. He is the founder of BayTrust Financial in Tampa, Florida. I remember, so we had this conversation, I think it was back in 2018. You actually predicted the bond market crash. Let's watch it.
Over the years, the bond market's always been our safe play. You know, interest rates are all-time high, you know, interest rates are coming down, bond prices were going up, and you're able to get attractive yields at the same time. Well, because that inverse relationship, we know that interest rates are going to start to rise, and we're seeing that. So when interest rates rise, that puts a lot of pressure on our bond market. So at that point, that safety net that we've had for the last 30 years is now becoming a risk. And same with the equities. We've had such a bull market that, you know, at some point we have a correction where, you know, that 60-40 isn't so much that conservative playbook. So I think we really need to start diversifying that portfolio, having some U.S. equities, maybe dipping into some international, you know, equities, some domestic fixed income, international fixed income, also maybe incorporating some real estate in the portfolio to really broaden, you know, the diversification in your portfolio. So not just diversifying to different ETFs, mutual funds, and having a 60-40, but getting into different asset classes.
So why have bonds really struggled in the past few years, and what risk do retirees really typically underestimate about using them?
Well, I mean, if you go back, we had the worst bond market that we've ever seen. You go back just a few years ago, 2022, going into 23, the Feds raised rates rapidly. And you have to understand that bonds have an inverse relationship with interest rates. So obviously when rates rise, bond prices fall. And so going into even rolling back even further into 2020 during COVID, we had the lowest interest rate environment that we've ever seen. And so you had a lot of investors that were going for bonds, which was a safe play for them to try to find yield, and it was very difficult. So when the Feds raised the rates, for those that had bonds, you saw bond prices fall rapidly. And some of the risks that came along with that was not only the value of their portfolio and their bond values going down, but you had inflation risk. I mean, you had these low yields to produce income. Meanwhile, inflation was extremely high, and so you were losing buying power. And what that forced a lot of investors to do is we saw a lot of money shift over into the high yield bond funds. And when you have a bond fund, obviously there's no maturity to that. So you have the fluctuation with the interest rates rising. Those high yield bond funds are even more sensitive. And those bond funds started reacting like equities, which really, Scott, defeats the entire purpose of owning bonds. So yeah, a lot of people struggled during that time frame, and it was a very difficult time period for our bond investors to allocate bonds in portfolios.
You see why his nickname is Nostradamus? So let's talk about another strategy. I mean, bonds typically aren't making sense, you know, for a lot of people. What's the other idea that we can use?
Well, of course, you want to diversify your income strategy, right? So bonds isn't the answer. And we always go back to the old 60-40 playbook, which obviously time after time it's proven to be broken. So you have to not only just diversify your portfolio, but in your income strategies, you have to get into other asset classes. So bonds have a place, of course, but we also can look into structured notes producing income there. The indexed annuity, you know, with income riders. The annuity is an attractive piece as an alternative class in the portfolio because it can guarantee you income for life. So dealing with the ups and downs of the market, we also have a thing called sequence of returns. So depending on, as an investor, when you retire, depending on what the market produces, an annuity, it doesn't matter, right? If you had bad returns early on, you have your guaranteed income stream, it doesn't affect it. And if you have good returns early on, same thing, it doesn't affect it. So having the stability with an annuity really helps with the income planning, with your bonds, structured notes. Obviously you have bank asset classes with CDs. So diversifying your income strategy will really help with stability, and that way you can have that income with confidence.
And, you know, so with all this information that's available to us, you know, on annuities, on bonds, on structured notes, would you agree that a lot of people, when you start working with them, they don't even have an income plan anyway? They just sort of have this big pile of assets. It's they look at the, you know, the stuff in the drawer maybe once every couple of years by accident when they're cleaning it out. So I mean, this the other question is, people should have an income plan.
Yeah, for sure. And so we always relate it to when you're working, right? Younger investors, obviously you have longevity, you have time on your side. You can be more of a passive investor, if you will. You can deal with the ups and downs because a couple things are happening. Not only are you reinvesting the dividends and the income that's coming off your investments, but you're also contributing to your savings, to your investments, so your dollar cost averaging in. The change happens when you transition to that retirement phase. And for the first time, you're no longer adding money to your account. You may be taking distributions. You're putting pressure for the first time, and you really transition more to the preservation income-driven phase of your life. And so coming up with an income plan, people just don't know where to start, right? And it becomes a little more difficult. You have to really come up with a customized plan tailored to your specific needs to meet your goals and objectives in retirement. And coming up with that distribution rate, we have to make sure that not only is our plan diversified enough, but we're going to be able to drive enough income so that way you can live that happy retirement.
You know, and the last question here too, so now we're in a period of volatility right now. A lot of what the market is doing in many ways doesn't make sense, but it's continuing to grow, but we've had these gigantic swings. What are you telling your clients now when we see the market really susceptible to the news cycle? Something comes out and then the market goes one way or the other in gigantic swings. How do you calm everybody down?
Yeah, I mean that's a difficult thing because obviously everyone you quickly forget about the tough times. When we've had this bull run that we've seen over the last decade, really the market's really overvalued, but there is some value in our marketplace too. So going back to diversifying your portfolio into different asset classes, different sectors, so that way you're not heavily concentrated in a certain sector. Tech's been the big story, right? And we've had a run up in our tech. So if you're not constantly rebalancing that portfolio, what you're doing is you're putting on additional risk that you might be uncomfortable with, because if one of those sectors decides to have a little correction, that could really affect your portfolio. So rebalancing is important. But again, you look into putting some guaranteed structures in the plan too. You want your growth stocks. You need your growth to keep up with inflation, but you also need to come up with income-driven investments too. And going with structured notes, the proper bond allocation, and possibly an annuity as an alternative class. Having that diversification will really help with volatility control and producing the income that you need. Obviously, you can't get ultra conservative because we do have to keep up with inflation. Right. So having the proper mix there will help continue growing the portfolio while you're driving income.
Thanks, Chris. Good stuff.
You got it, Scott.
He knows what he's talking about. So he is the founder of BayTrust Financial in Tampa, Florida. He's a radio host. He's a podcast host. He can't stop talking, really. But anyway, if you want to find out more, contact him at BayTrust Financial in Tampa. This is Retirement News Online. Thanks for watching.